Hello, my name is Michael Stoller, host of the Stoller Report and host of the mTrust Title webinar series. The topic today is, it's like Mark Twain once said, the demise of my life is not taking place. The rumors about it. And it's a question of the demise of New York City, the demise of the office built state, and the demise of real estate in general. We are not being a demise, we're moving ahead. And even though we're in the summer, the world will change when things take place in September. The people to discuss this topic include Jason Hernandez, Managing Director, Head of Originations for Debt for Nuveen. Nadir Settles, Managing Director, New York Office Real Estate Americas for Nuveen. And last but not least, Paul Amarick, Vice Chairman of CBRE. So, Nadir, you're the guy who has 9 office buildings in New York City today. How do you look at the office market?
I'm excited about the office market. It's going through a time of change. Certainly, the COVID-19 has presented, our operations as far as occupancy, the forward trajectory as far as capital markets and the dislocation there, its challenges. And we also see that as an opportunity as being New York focused investors. And so I think at the moment, with having just such a big footprint of office space, we just want to make sure that we get our tenants back safely, and just thinking about the reoccupancy of our buildings right now, which are sort of hovering around the 7 to 10%. And so we're worrying about health, wellness, hygiene. And just trying to take protocols and steps to how we ensure sort of that staggered reoccupy. And so we've made some adjustments to our office buildings as far as increasing sanitizers, and we require masks for all of our common areas. We're going to be implementing and putting down markers to ensure sort of one-way trafficking to ensure social distancing. We're using technology and building apps to help to integrate building operations and limit sort of face-to-face, whether it's a maintenance request or whether we can do some sort of ordering from any of our amenities. And then just the enhanced cleaning. So we've upgraded to electrostatic sprayer cleaners that will help to sort of provide higher cleaning, and with cleaning at a higher frequency.
Are we seeing people, this is a question for Paul and to Nadir, are we seeing people looking for additional space today? Are tenants out there, or are they waiting till September when there's better hopes for the vaccine, when the world is expected to be in better position, or are we in a very quiet time? I mean, you read in the press about the Facebook and the Amazon, but these leases were really begun pre-COVID. Today, are there
Sure.
tenants in the market looking for space?
So I'll address a couple of those points, Michael. Number one, there are tenants in the market today. It's a small percentage of what we're normally used to, call it pre-COVID. But on average, over the last 3 weeks, our team's been conducting anywhere from 10 to 11 tours a week. I think what we're seeing out of that is a slower process, to call it move from tour to term sheet to potential lease. To speak of those larger deals that definitely were at lease prior to COVID arriving, I think the fact that they got concluded is a big statement for New York City that goes against a lot of what we read in the press, which is that they could have walked, or they could have pivoted, and they could have moved some of those jobs to other cities in the country that they felt more confident about. But the fact that they concluded those deals, they didn't chase the size of those deals, and that those commitments, like with a Facebook, are so far out, like they're not going to occupy space in that building next year. I think that shows their commitment to New York City, what New York City has always stood for, and the fact that the talent will always be here. We're in an interesting hiccup period. I agree with Nadir. It's presented some challenges, but I think we come out of this a lot smarter than we were before. And I believe our buildings will be better for the long term because of what we've learned through this. But at the moment, to go back to your question, we're seeing a fraction of what we're used to, and the timeline is a lot longer. but we're hoping that after September and after kids are back in school and people are back at work in some sort of, new normalized format, that deal flow is going to increase and we're going to see a better flow of leasing activity.
So here for Nuveen, we have two sides of the table. We have the ownership side and we have the lending side. As a lender, Jason, how do you look at the office market today, especially since it's approved? And it's easier to get an industrial deal approved than an office deal.
Yeah, no, I think you touched on it at the end there, Michael. You were breaking up a little bit, but I think it's, when you think about office, it's all about relative value, right? And I guess I'll expand on you started off with a Mark Twain quote. Like, when you think about the financing market, it's really a tale of two cities, right? And I think everybody likes logistics and housing, because not surprisingly, everyone's in their house and ordering Amazon, which is delivered via logistics. So that's kind of pretty straightforward. And I think, so that market is incredibly liquid. If you look at the pipeline today, it's probably overall it's 40 to 50% of what it was pre-COVID, but it's demonstrably overweight industrial and housing. And so when you think about office, right, it's really a relative value play, because you're right. I mean, it is more challenging today, but as I look at the world and we look at like our pipeline, where we see better relative value, i.e. better spreads and more attractive returns on the financing side, is on the office product, right? Because number one, it's out of favor, but also, as Nadir talked about earlier, right? I mean, when you think about all, the capital markets have backed up considerably on office product, right? So if you think about the life cycle of all these investors, we're no different, right? You buy an asset, you fix it up, and then eventually you sell that asset. Well, if the capital markets are closed for sale, a lot of these investors want to recapitalize those assets. So the financing markets are open, and they're presenting attractive opportunities. So, I look at office and I say, like, we had a deal today at committee, and I would say spreads on office deals are probably 100 to 150 basis points unlevered wider than industrial. And when you're talking about, whole loan coupons in the 4% range, that 150 basis points is considerable. And that's how we're thinking about office today, is purely relative value. And Nadir and Paul can talk about, in our prep call, Nadir was talking about this, but not all office is created equal, right? So we like life science, we like medical office, boutique office. And so I think there's even segments within the office market we can drill deeper to see where there's liquidity and where the opportunity is. But I think it's a relative value trade today, and we're open for business on office for sure.
What about suburban office?
Yeah, look, it's interesting. We talked about this, we talk about that a lot on team, and it goes back to relative value. And, I've been doing this a long time. And look, I think, long-term, suburban office has not been a good trade for a lot of people. And you can talk about demographics and the shift to transit-oriented development and CBD type locations. But this presents a unique opportunity with COVID, right? Because everybody's working from home, and there is a natural knee-jerk reaction to want to be closer to home and to seek out less dense spaces. So we're spending a fair bit of time. The deal we talked about today was candidly, I'd call it urban suburban. A deal in Atlanta was urban suburban, because that sounds better, but it's not really suburban, it's not really urban. But it was, and for that very reason, we like it. It's a drive-to destination, so there is no public transit. It's much less dense. It's in a park setting. So it's 5 stories versus a 50-story tower. So you don't have some of the logistics of getting in and out of a building. And look, do I think that's a great 10-year trade? No, I don't. I think it's a great 2 to 4 year trade. And we're looking at suburban office in that short-term window could be a place to get yield and get out and just to play on the capital markets.
I mean, Paul, are some of your New York City tenants looking for small suburban offices? Or you want to tell the story about the Greenwich office buildings that you were seeing?
Yeah. So we live in Connecticut, and there's been a lot of folks up in our area that have said, we're working from home and doing fine. I think I agree with Jason. Like, you may see some knee-jerk moves where somebody goes and takes a small piece of space in the suburban market close to their home. But the question is whether that sticks long term. I think you might see a pop in the next year or so, but then, maybe that's a trade to get out of. I'm not sure it's a long-term trade, because I think New York reverts back to where it was, and people realize that they miss being with the mothership, if you will. So I think you might see a little pop right now, but based on just my local knowledge of living up in Connecticut, there was a lot of discussion around the suburban markets were going to have a big run, and I don't think we've seen proof of that yet in terms of actual done deals. But some people kicking the tires, but not a flourish of it.
When we talk suburban market, let's talk about what do we consider Jersey City, Fort Lee, or the, right over on the border.
I think when you talk about Jersey City, that's an interesting play because it's so close to Manhattan and by ferry. Look at what Goldman Sachs did over there and a bunch of other large corporations. I think that's different than, I wouldn't even put that in a suburban discussion. But Nadir, sorry, Michael, maybe Nadir can expand on it.
You know what? I would say history, we have seen this before, and history will repeat itself, that knee-jerk reactions do happen. It's just a part of the human psychology that when people have to, one, do things by necessity. So necessity may mean that we can't come into our space, into the city, just because we're not confident with the transportation system, not confident in the efficiency of us moving around. So let's go from our house to our car. Go from our house to our car to our suburban office, and we can do that in the interim until we figure things out. But long term, it reverts, right? And that same thinking already played out. We've seen this with 9/11. What happened? UBS shot up to Stanford. Goldman Sachs and a bunch of guys shot up to Jersey City. And what did they realize? They realized with time that, hey, you can keep some people back there, but the younger talent, they want to be a part of the city. They don't want to be doing this reverse commute, especially when they live in the city, and they want to be a part of going into work and that sort of seamless experience, going into the work from their neighborhood and to the office and coming back, going to dinner, hanging out, and not having to jump on the Metro North or the Penn Station or the ferry, right? We've seen this all play out, and I think it happens again. So there may be a temporary pop, and if we can play it smartly, we should, as far as, how do we get in and out of suburban office over the next 1 to 3 years. But long term, I think the city is resilient. The talent, it's a talent magnet. People will want to be back in the cities, and the companies will want to be back here with the talent.
With regard to working, all of your companies, what's the policy right now of when they want you to come back to New York City to operate out of your office, as opposed to Long Island, New Jersey, and other places? Jason and Nadir, what's the new Vines?
Yeah, look, I think our policy is, we're not, the firm policy is we're not going back to the office until sometime in 2021. But more importantly, I think the firm was, the parent company was on the forefront, and what they said was, given all the uncertainty, if anybody wants to or needs to, they can work from home till August 2021, right? So just giving people some certainty around their personal decisions. So look, I hope I'm not here on Long Island till next August. Like, I would love to get back in the city and see my team, but I wouldn't imagine, and we should probably talk about this, right, Nadir? I think the office, probably won't go back to the office till sometime in 2021, but I plan to be back after Labor Day when my kids start school. And we've all talked about, Nadir and I and our teams, how do we find ways to reconnect, right? And Paul, we talked about this as well, is even if you're not in the office, you've got to find ways, this connectivity, especially with new talent coming in and in uncertain times. How do you find a way to connect with people outside of these great Zooms? How do you find a place outdoors in New York City to do that?
Yeah, I think that's spot on. And that's even from connecting with clients to teammates, right? You're going to have to find physical ways of doing that, or whether that means that we start to have, catch-ups with our counterparts in various different ways in a park, our teammates in some sort of social distance appropriate way. But physical office won't limit physical connectivity, to say.
Okay, a couple of questions. Where do you see the world in the future with regard to co-working? Nadir, you have tenants who are co-working. Paul, you've had both sides of the table. And Jason, you may have lent money on co-working space. How do we look at it today? Because it's, ever since change, Newman leaving the company, the world changing, some of the other companies going out of business, where do you see it today?
Co-working is here to stay. That kind of flexibility, being a solution provider for enterprise tenants. I think there's tenants that just saying, listen, I don't want to handle my real estate needs. That's not my business. Can someone come in, provide that sort of, roll my business out in the bag, my employees show with our computers, and we pop them into some desk, and somebody has thought through all of the logistics and the planning of that. That's here to stay. Hot desking, that business has been disrupted. And I think there'll be some consolidation in that business. And then there'll be somebody that figures it out, sort of like what I would call co-working version 1.0, when Regus and all those other co-working companies were a part of that business. And there was a lot of consolidation, and then it evolved. And so I think the co-working business will evolve and mature, and we'll see what hot desking looks like in version 2.0 of co-working. It certainly won't look like today, but there will be a survival of that, because there still are groups that found that attractive, right? Because if I'm an entrepreneur, before I go and incur an office cost, I could, if it was more attractive for me to just work out of my home, I would have done that. But there's something around teams of 4 wanting to be around other people in an office setting and be around that small collective group of people that's within that firm. So I think that will survive. It just will look a lot different. And I'll turn it over to the rest of the guys.
Before I ask Jason about lending on co-working, I want to ask Paul if he remembers when co-working was hoteling. Most of the accounting and law firms had the hoteling. Do you see hoteling coming back?
You know, I do remember that. Unfortunately, I can say that by age, but I do remember those days. And I think that, you know, co-working is an evolution of what we called hoteling back then. And I agree with most of all of what Nadir said. I'll tell you that our firm launched a new brand called Hana about a year ago. And part of the reason our investors felt very confident about that is that we were listening very specifically to big corporate institutions like Nuveen and others that said, we want some flexibility. We want somebody that's going to be a partner and not a competitor within our office buildings. And I think, listen, if we were all sitting here 5-6 months ago, there were many people that were betting that WeWork would not survive. And now when you look at how their new CEO has cleaned up the company, they've shed a little bit, but they've really cleaned up their mission statement. And then SoftBank, I saw yesterday's committed another $1.5 billion to them. That's a big statement. Whereas if we were reading in the press 4 or 5 months ago, SoftBank was walking and potentially in a legal battle with the then C-suite. So I think that says a lot about that business. I think that big corporations are taking advantage of it in this kind of time frame where they don't want to make long-term commitments, and that's a good solution on the enterprise space. So, you know, I agree with most with what Nadir is saying, and I think you'll see it maybe even do better coming out of this than it was pre-COVID.
Jason, you're the lender over here. You have an anomaly. You're a different person. You can look at it in varieties of ways.
You know, it's interesting. I look at it the like most things, right? The pre and post COVID view, and I would say, you know, pre-COVID, you know, the market standard was any more than 35% co-working, whether it's WeWork or somebody else, was just difficult to finance, right? And that really was more a function of it was risk profile, but the real governor was right. All these lenders, these debt funds, you know, they're levered lenders, and so they've got to be able to finance their position. And a lot of the commercial banks provide that grease or that liquidity to that senior financing market, and that's where the governor came from. And if you look at the most attractive opportunities today on the office side, are not surprising. There's a story to it, and you know, I'd say today that's probably 20 to 25% co-working, right? Is kind of the max limit you'd want to see. Like you can't sit here and, you know, to Paul's point, it's an evolution, right? Is where there was hoteling back in the day, and now it's, you know, like you could almost argue the lines are blurring between people that do like spec suites, right, for office. And Paul, you can talk about what's better than I could, right? But like you're looking at spec suites today where people are providing furniture, like they're almost providing a turnkey service without the IT service, right? So these lines are blurring. So it's, you can't just say, hey, I don't want co-working in my space. You'd rather not have it for sure because it's more risk. But again, you know, if I'm going to be intellectually honest, I'm not sure what the difference between having a co-working space for 20% of my building or having 25% of my building be, you know, spec suites built out in 2,000 square foot increments or 3,000 square foot increments with a bunch of different tenants that my landlord has to manage. So look, I think that, like you said, it's here to stay, and you know, we're trying to be thoughtful on it. I do think the conversation, you know, to Paul's point about what WeWork has done, the conversation has shifted from are they a going concern to, hey, how does this impact my building, right? And how do I manage through that rollover? Whereas, gosh, 4, 5, 6 months ago, a year ago, it was a very different conversation as it relates to co-working, which I think is a positive.
Here's a question since you are the only lender over here, and many of the banks have really stopped lending. I mean, I happened to speak to two chairmen of banks today, and I said, "Are you lending on real estate?" They said, "We're lending to people who we know."
Yeah.
So I said,
Yeah.
"You're only lending to people you know?" They said, "That's correct." And then we're looking at lending in certain ways, and if it has that terminology called retail, we don't know what that is either. So
Yeah.
since you are the lender, tell us what you're doing in the perspective on a national basis of what Nuveen's lending market is.
Sure. And I look, I would agree with that. I think most of the banks, you know, they've been so focused on PPP loans in their existing book, right? So there's been a much more focus from the government on down to focus on small business. So real estate has taken a back seat. So they're not very active. So if I think about our platform and kind of the three legs of our stool, I would say on the fixed rate kind of long term core debt we do, that's almost exclusively focused on industrial and multifamily, right? For many of the reasons, the demographic tailwinds. On the transitional floating rate side, you know, because the banks aren't active and that senior financing market is opaque and somewhat illiquid, you know, we're much more active in that space today. I would say the analogy I would use is I'm not sure we've ever worked as hard with as little to show for it. And what I mean by that is there aren't as many trades out in the market, right? So there's you know, in a liquid market, for example, there's probably 25 deals we would be actively bidding on that we wanted to do. Today in that space, there's probably 3 to 5 nationally, and everybody wants to do those deals. And so those deals are being priced on an unlevered basis. So spreads today are anywhere from 100 to 200 basis points wider on, and it's primarily office, industrial, and pre-stabilized multi. Or when I say industrial, it's really redevelopment plays. So that's where we're focused. On the office side, it's really, hey, a bridge to a sale, because I don't think anybody wants to take lease up risk today in office, because I don't think you have to. I think, you know, there's so many of these trades in the market where they couldn't sell, and you can go ahead and you can bridge somebody to a sale today with minimal risk and get paid for it. And then on the multi side, it's all pre-stabilized, right? The Fannie and the Freddie, the agencies are very active, and so it's very difficult to beat them. You can compete with them on a deal coming out of construction where you'll take the lease up risk, right? I think we've got a very big housing portfolio. We think we understand that space. We're comfortable with that risk profile. So we'll underwrite lease up multi. And then on the industrial side, I think you got to go further on the risk curve, right? Because it's so attractive. It's either redevelopment plays or it's something with an Amazon redevelopment type play is what we're looking at.
So here's a question, Nadir. You over the last couple of years, you've made a number of acquisitions throughout the city. Okay, are you looking today for any acquisitions, or are you trying to just take care of the properties that you have and stabilize the properties and increase tenants and so on?
Our heads on a swivel. So we're certainly playing defense, taking care of our properties, making sure that they're equipped to have our tenants come back and feel safe. But we're playing offense as well, right? We think that this is the opportune time to buy when there's this much market dislocation. And so we're certainly looking at assets. There'll be some trouble in the market where we think we can get things at a really attractive basis and we can do well by our investors. And so we're well capitalized to take advantage of new opportunities that come to market. We just haven't seen, it's been limited activity to no activity right now, but we'll be patient. And we've seen coming out of the GFC that activity, you know, may take 12 to 15 months to pick up. But we'll be patient, and we'll, you know, we're New York focused. And so, you know, if it comes before that, it does, but we're certainly looking for opportunities.
Yeah. Well, CBRE has been a major player in the investment sales business for decades. Okay, where do you see the investment sales today in the metro region? Are transactions taking place? Because looking at what I've been reading in the press, there've been very few office buildings that have traded. There may have been some suburban office buildings, you know, like the Roche properties or certain other properties where their life science tenants are going in over there. But with regard to the standard office buildings, A, B, and C type of property, are you seeing any transactions?
Well, listen, by no means would I ever try and speak for my expert, Darcy Stakem, who runs that group here at our firm, but I would say we stay very close to Darcy and her team, and what we're understanding is there's a lot of discussions and a lot of valuations happening, but very little trades. And back to what Jason said, you know, he's never worked harder. I think we sit in the same camp, like whether it be Darcy's group on investment sales side, our side on the leasing, we've never worked harder and probably had less quick results. But I am a believer that there is a silver lining to this hard work, and that coming out of this, I think folks will be very thankful for the amount of time we spent with them and the advisement and the coaching and the information flow, and that, you know, you get paid for it in the future and on the back end. And I think that, back to your question, I think you're going to see once this gets in the system, if you will, kind of call it, you know, the market finds its feet, I think you will see more transaction flow on the sales side, and that's where I think you see folks like Nuveen and others start to really try and buy New York at a discount that they can look back at and say we took advantage of that downturn.
Here's
You
the
know,
question.
Michael, hey,
Yeah.
I'm sorry, go ahead. Go ahead.
No,
I was just going to say one thing. I'd be remiss if I didn't mention, but you know, follow the corporate. So we just seen Amazon make a $1.4 billion purchase of the Lord & Taylor building, right? That was a significant purchase, but corporate occupied. So not necessarily we're talking about on the investment sales side, but that was a significant purchase in sort of signaling that physical office still remains a priority. And we've seen another sort of owner occupied with JP Morgan just purchased the building in 410 Madison. So those were transactions on the owner occupier side, but those are significant in absence of sort of your traditional capital markets.
Yeah, and I would just add, like, you know, we always talk, and we do this as well, right? We talk about the world from the equity and the debt perspective. And I think, you know, in times of disruption, right, like those worlds tend to blend, right? So, you know, Michael, you made up the point that, hey, look, there aren't a lot of office trades in the market today because you're not going to sell unless you have to. What you are seeing is a lot of mezz positions start to be marketed, right?
Mm.
So that bridge capital between, you know, Nadir as a pure owner and me as a pure lender, like those lines are starting to blur. So we're seeing opportunities today where it's, you know, whether it's, you know, there's big New York City owner operators that are selling mezz portfolios, right? And those could be really interesting opportunities for someone like ourselves or other groups, right? We're not the only group that does equity and debt together. And so I think, you know, like if you think about the life cycle and where you're going to see activity first, right? You're seeing it in logistics and housing. You're going to start seeing it in the office space in terms of these mezz positions trading and accessing, you know, for Nadir and his fund, trying to access that capital vis-a-vis a mezz position because those capital markets are not functioning appropriately. Could be an interesting opportunity, and we're starting to see more of that. Nothing we like yet, candidly, but we're seeing a lot of it, and we anticipate we're going to see more of that going forward.
You're also going to see some. You'll see some pref equity positions as well. We just saw one on 1375 Broadway, and I think that's another way to get in the space in a little bit of a different tranche and put some money to work for a coupon, and maybe you get lucky and step into some equity. I mean, yeah, we'll see.
Yeah, that's right. I think to both your points, that's what we'll see as the first wave of deals in disruption is sort of debt or pref equity, and that's what's been sort of. We've been evaluating some opportunities that have come to market over the last couple of months.
With regard to I'm a tenant, let's say. I'm the managing partner of an accounting or law firm. Is it a good time for me to being out there and negotiating to find a lease? I have the broker over here and I have the owner over here. What's the thoughts on that?
Yes. I mean, I will say that owners that are sitting with vacancy today, or owners that have you currently as a law firm tenant and you're at risk to leave their portfolio, are reaching heavily to either retain you, or owners that want to fill their vacancy are getting incredibly aggressive, not so much just on the rent. I mean, you're seeing some aggressive rent movement, call it spreading the bid ask a bit, but you're seeing a very large amount of free rent thrown at deals to make them. And if you're a law firm and you have partners and the bottom line matters and you're willing to make call it a 10-year commitment, you're probably going to get a lot of free rent that's going to definitely benefit you and your partnership, and be able to reset a base rent that's likely lower than what you've been paying for the past 10 years. So I think it's a great time to transact. And as we said before, even in our prep, it's when everybody's afraid to do anything might be the best time to do something. Some people say, I never want to be first, and if I leave a little money on the table, I'm okay with that because I don't want to be the first to go and take the risk. But I think for the people that are out there and looking to lease space today and willing to sign a lease, I mean, we're representing a few right now on the tenant rep side. Some of the packages that we're seeing thrown around are like I've never seen before. And I think tenants will look back in a year or so and say, gosh, I'm so glad I took advantage of that. Because I think once the reoccupancy starts and people feel more confident about New York, and you start to see, call it a stabilization occur, you're going to see the belt tighten between the bid-ask spread, and landlords are going to feel that much more better about their ownership positions and their ability to lease the space in a quicker time frame.
So since we have a landlord over there, what are you doing these days when a tenant comes to you and says, I'd like to renew my lease for 10 years?
No, absolutely. I mean, my view can't be more consistent with Paul, right? That, you know, we're in the business of keeping space filled, and our lenders want us to keep the space filled. So that couldn't be probably more consistent with Jason and what Jason's thinking. And listen, in a time like this, if you can signal some confidence and we have vacancy or a renewal, and you say, listen, I'm gonna go long, then we will, you know, sort of, you know, make the most beneficial deal that motivates someone to do a deal today, and our competitors are going to do the same, right? But you made that deal in a time of higher uncertainty where it was tough. We're not getting the same tours, we're not getting the same you know, leasing traction. And so when someone comes, and we want to retain first our tenants that are here, we certainly want to strike the most attractive deal for them. But if it's a new tenant, we certainly want to lure them to our building versus a competitor's building. And so we'll do what we have to do. And I think tenants are smart to lock up deals when there's high uncertainty and take advantage of sort of, you know, economic impact that can be certainly beneficial over the long term.
You know, everybody is questioning if people are ever going to come back to work full time. I believe this is like the fact that you were talking about great opportunities to be downtown and other markets. Where do you see the situation when and if we see 80% of our employees working from the office and 20% at home? Is this a year from now? Is it 6 months from now? Or is it the question that this is inevitable, that it's going to take place, that people are going to go back to the office because the work environment of dealing with people, of seeing people and discussing face to face, even though it may be 6 feet apart, but the capability, you can't do that when you're doing a Zoom or a WebEx telephone call.
To clarify your question, are you saying 80% all in at once, or in a rotating fashion, Michael?
In a rotating fashion, perhaps.
Oh, I think you could see that, you know, kind of end of first quarter next year. I'd say, I'm going to say more closer to, call it the end of spring of next year would be my personal prediction.
Yeah, I would agree with that. I think you need a vaccine first, right? The MTA is doing everything they can to sort of enhance and provide safety as people move through the train system. And then, you know, with a vaccine, I think you have too much pent up demand of people missing the collaboration, you know, the culture, you know, productivity is, you know, it's still, the jury's still out on whether, you know, people are more productive. There's a lot of inefficiency between having to pick up a phone or get onto a Zoom versus if, you know, someone's in your office, you walk over to Paul and you say, hey, this is, and you solve for that in a really efficient manner. And so I think, you know, people want to be back in their office, but they want to feel safe as well. So I think, you know, everybody's talking about a vaccine late this year, early next year. And I think, you know, with that vaccine and it being able to be administered in scale, I think you get back to the office in a substantial way, to Paul's point, at the end of the second quarter.
So let's get some conclusionary comments of your thoughts 6 months from now and a year from now with regard to the financing market, with regard to the office market, with regard to the industrial market and the life science market. Let's start with Nadir. You're the owner. You're buying. You have the money to buy. Jason's the hard money guy lending.
I love life science today. I think in the backdrop of a pandemic or many other sort of curable viruses and diseases, life science will continue to proliferate. New York is you know, it doesn't have a lot of space for that. And so if you're able to, and it doesn't even have a lot of stock that can just easily be converted. So if you're able to take hold of a building or be able to convert a building to life science, I mean, I think that is the way to go. The traditional office market, I think it's going to be the tale of two cities. There's going to be office stock that is going to be prime, class A, innovative, satisfy health and wellness, and where occupiers want to gravitate to. And then there's going to be the rest of the stock, class B buildings that, are in good markets, but no one wants to be there because it doesn't have the aspects that help to support, health and wellness. And so I think the class A office space returns, a year from now, and life science, we can't get enough of life science.
Paul.
So I'll go off the heels of what Nadir just said. I think that I'll call it, there'll be a continued flight to quality in Manhattan. I think some folks will be able to look at their footprint pre-COVID versus post-COVID, trim a little bit off of their footprint based on maybe realizing that some folks don't need to be in the office or in Manhattan 5 days a week. And that will give them the ability to afford that higher rent because they're taking slightly less space in that flight to quality. I think that in 6 months, you're going to finally understand where the market is from a leasing standpoint and economic standpoint. And the hope would be in a year from now, we've stabilized ourselves and we can start to kind of plan for some level of growth as we head into 22.
Jason, the man with the money, where do you see it?
Yeah, it's to piggyback off what Paul said. Look, if somebody had asked any one of us 6 months after the Bear Stearns hedge fund went insolvent, how this was going to play out, nobody would know, right? This has happened in such a compressed time frame. It's only actually been 5 months since March, right? Maybe 6 months. So it's still so early. So, but if I look at what's happened over those 6 months, I would say, as it relates to the financing markets, 6 months from now, I'm not sure they'll be liquid, but they'll be less illiquid than they are today. So the double negative, there'll be more liquidity in the markets. We'll have more certainty. And if you just follow, if you look at, in the beginning, you first saw this distress in the equity market, in the corporate credit market, and those spreads blew out, and then those spreads have compressed. And then I think what you've seen is in the private credit market for real estate, the debt funds we talked about, those spreads have blown out. I think 6 months from now, though, hopefully, God willing, if Nadir and everybody, we all agree that there's a vaccine and we're closer to therapies that are effective, there'll be less focus on small business lending from these banks, and they'll get much more active in the repo and the senior financing market, which will bring liquidity. So I would say 6 months to a year from now, the financing markets will be much more liquid. And I think that's going to be your first indicator. From that point, once you have liquid financing markets, then I think that's going to be the grease that's going to grease the capital markets on the office side, so you can start seeing some transactions, because you're not going to see active and buyers and sellers unless you can finance those positions. So I'm pretty bullish over the next 6 to 12 months. And in that time frame, in terms of property types, look, I also love, I would say, life science, single family residential, and medical office, just playing kind of macro trends with going on in the country right now. Like, look, people, even before COVID, put aside whether people come back or not, you had an affordability crisis with major cities, New York, San Francisco, elsewhere. And I think, what you're seeing is, there's a psychological impact to this. And I'm not a doctor, and I didn't play one on television either, but I do think coming out of this, young people are going to say they're going to value optionality, right? And so I think you're going to see less people want to pluck down for a down payment for a home, because this generation is much more mobile than we were. And so I think single family residential is going to be a great place to play. I think life science, for the points Nadir mentioned, and then just medical office in terms of just the graying of America.
And I think something that we discussed before, the data centers are going to be big, because look at all the people on the data that we're talking about right now. So Mike Stoller, host of the Stoller Report and the AmTrust webinar series. I'd like to thank Nadir Settles, Jason Hernandez, and Paul Amrich. Thank you very much. Have a good day.
Thank you.
Thank you.
Thank you.
You as well.